All right, welcome to The Explainer. Today we're diving into two really powerful ways to get a piece of the world's most innovative companies. Think of it like a classic investment showdown, pure, raw growth versus steady, high income.
So, let's get right into it. You've decided you want to own a slice of the Nasdaq-100. You know, the home of all the tech giants that are basically shaping our future. The real question isn't what companies to buy, it's how you want to own them. Are you playing the long game, trying to maximize your growth? Or do you need that portfolio to start cutting you a check every single month, right now?
So we're putting two ETFs, or exchange-traded funds, into the ring. Now, here's the fascinating part. They're both built on the exact same foundation. The top 100 non-financial companies on the Nasdaq. We're talking NVIDIA, Apple, Microsoft, all the big dogs. But, and this is a big but, while they're holding the same stocks, their game plans could not be more different.
First up in the blue corner, you've got the original champion, the Invesco QQQ ETF. I mean, this thing is a legend. It's one of the oldest, most traded ETFs on the planet, with a track record of over 25 years. Its mission? It's simple, it's direct, it's all about growth.
QQQ's strategy is beautiful in its simplicity. It's a passively managed fund, which is just a fancy way of saying it doesn't try to outsmart the market. It just buys and holds the stocks in the Nasdaq-100, plain and simple, trying to match the index's performance. The entire goal here is what's called capital appreciation, just growing your initial pile of money as big as you possibly can over the long haul.
And this slide, this really tells the whole story of QQQ's philosophy. It's passive, it's all about growth, and everything is built for efficiency. Just look at that expense ratio, only 0.20%. It's super cheap to own. But then look at the dividend yield. It's tiny. QQQ isn't designed to pay your bills this month. It's designed to build your wealth for decades from now.
And now, entering the ring as the challenger, we've got a newer, much more complex contender, the NEOS Nasdaq-100 High Income ETF, ticker QQI. Now remember, it holds the same tech titans as QQQ, but its goal, it's completely different. This one is all about generating a massive monthly income stream.
Okay, so how on earth does it do that? Well, QQI uses an active strategy called covered calls. The best way to think about it is like you're a landlord for your stocks, so you own the shares, right? But you also sell these things called call options, which is kind of like renting out the potential for your stocks to go way up in value. In return, you collect a monthly rent check in the form of these option premiums. The trade-off, of course, is that you give up some of that explosive growth potential in exchange for getting cash in your pocket right now.
QQQI also has this really clever trick up its sleeve for tax efficiency. A lot of the money it pays out is classified as a return of capital. Now, this isn't a dividend, it's not a gain, it's technically the fund just giving you a piece of your own original investment back. The cool part is it's not taxed as income this year. Instead, it just lowers your cost basis, which basically means you get to kick the tax can down the road until you eventually sell your shares. So QQQI's profile is pretty much the polar opposite of QQQ's. The strategy is active. The goal is high monthly income. But look, that active management comes at a price, an expense ratio of 0.68%, which is more than 3 times higher than QQQ. But the payoff? A truly staggering distribution yield of around 14%. This thing is an absolute income machine.
Okay, so we've got the theory, we've got the strategies, we've got the stats. But how did these two actually do in the real world? Let's put them head-to-head since the challenger, QQQI, stepped into the ring back in early 2024.
This chart just perfectly illustrates the fundamental difference in their journeys. We're looking at 100 grand invested in both. Now see QQQ, that blue line? It's a roller coaster, right? Higher peaks, but also much steeper drops. Then you have QQQI in green, charting this much smoother, less bumpy path, cushioned by all that monthly income. In a roaring bull market like this one, QQQ's volatility meant bigger gains, but you have to ask yourself, what if the market was flat or down? That smoother ride from QQQI is you could be a huge defensive advantage still paying you while the growth fund might be losing value.
The numbers here on the tail of the tape tell the exact same story, but you have to remember the context is everything. During the strong bull run, QQQ's pure growth strategy delivered an absolute knockout punch, a total return of over 44%. Your 100 grand became over 144,000. Meanwhile, QQI, because of its design, capped that upside and returned a very respectable but much lower 8.74%. I promise you, these results would look very, very different in a bear market.
And part of that performance difference, well, it comes down to the price tag.
QQQI's active, hands-on option strategy is just way more expensive to run. That 0.68% fee, compared to QQQ's 0.20%, creates this small but constant drag on performance, year in and year out.
But this is the reason for that higher fee. This slide shows the trade-off in the most dramatic way possible. QQII is designed to pay you, and boy does it deliver. With a massive distribution yield around 14%, that is the income it is spinning off for investors. QQQ, on the other hand, it's paying out next to nothing. It's putting all its energy into growth, not cash flow. So, at the end of the day, who wins the fight? The growth champion or the income challenger? Well, here's the crucial point. There is no single winner. The better ETF depends 100% on you, on your financial goals, your age, and frankly, how much risk you're willing to stomach.
Let's just break it down nice and simple. QQQ? It's pretty much tailor-made for younger investors who have decades for their money to compound. If you can handle the market's wild swings and your main goal is just to build the biggest nest egg possible for the future, the growth champion is your guy. But if you're getting closer to retirement, or maybe you're already there, and you need your portfolio to generate predictable cash to live on, well, the income challenger, QQQI, was built for exactly that.
You know, this comment from a user on Reddit really just sums up the conventional wisdom perfectly. It's all about aligning your investment strategy with where you are in life. Early on, you go for growth. Later on, you shift your priority to cash flow. Simple as that.
So really, it all boils down to this one fundamental trade-off. With QQI, you are making a conscious choice to give up the chance for those incredible, jaw-dropping growth years that QQQ can deliver. And in exchange for that sacrifice, you get a significant monthly paycheck and a much smoother, less stressful ride, which can be worth its weight in gold when the market isn't just going straight up.
And that's our explainer on the big showdown between QQQ and QQQI. It really just leaves us with the only question that truly matters, and it's a question for you. What do you need your money to do for you, right now? You answer that, and you'll know exactly which of these champions belongs in your portfolio.